All right, hey everyone, welcome back UPSC aspirants. Ready for today's deep dive?
Absolutely. Always ready to jump into these crucial
And
topics.
today's is a big one. Straight from the headlines and could be a game changer. We're talking about India's fiscal policy, specifically the huge EE shift, and I do mean huge EE, from focusing on fiscal deficit targets to a debt to GDP ratio. Starting, get this, in FY 2026 to 27.
That's right. Big change. Definitely something the UPSC examiners could throw at you. It's a whole new way India's thinking about managing its money. Could have ripple effects, throughout the entire economy.
So, okay, let's break it down for everyone listening. What is this debt to GDP ratio? Like, what does it actually tell us? And why should it matter to, well, anyone aiming for those top ranks in the UPSC exams?
The debt to GDP ratio, well, think of it like this. It's basically a way to assess a country's economic health. By comparing its total debt to the size of its economy, you get this ratio. And a high ratio, that can signal potential instability, right? But a lower ratio generally means, well, a healthier financial situation.
So for our listeners who are, prepping for the UPSC, understanding this ratio isn't just about, like, acing those economics questions. It's about really getting this concept, a concept that impacts government policies, investment decisions, even India's position, like, globally.
Yeah, exactly. It's fundamental. You'll see it everywhere. Current affairs, economic reports. You'll even see it when countries are compared, internationally. Now, India's current situation, the budget projections. Well, they're showing a debt to GDP ratio of around 57.1% for FY 2024 to 25, dipping a little to 56.1% in FY 2025 to 26.
Okay, so those are the numbers, but what's the GIL here?
The government's goal. Ambitious. They want to bring it down to 50% by 2031.
Whoa. Okay, that IS ambitious. So why this change? Like, what's pushing India to make this shift NRW from focusing on that yearly fiscal deficit to, well, this broader debt to GDP measure?
There are a few reasons. First, transparency. Focusing on the total debt, relative to GDP. It makes it harder to, well, it's like you can't sweep things under the rug. Borrowing that's happening off budget. It happens sometimes when the emphasis is only on managing that annual deficit.
So it's about, like, presenting a clearer picture, India's overall financial health. What other advantages does this new approach have?
Well, it's more accurate. Gives a more comprehensive assessment, the country's fiscal sustainability
Yeah.
over time. Because the debt to GDP ratio, it looks at all the debt from, previous years, not just the current fiscal year. It's a longer term perspective.
Okay, yeah, that makes sense. It's like if you're tracking your credit card debt, the overall debt, not just what you spent this month, gives you a better idea of your long-term financial well-being, right?
Exactly. And third, flexibility. This new approach, it gives more flexibility, especially when, the economy throws those curveballs, like a global recession or a natural disaster. You need to spend more, right? But with this framework, you have more room to adapt without totally messing up the long-term fiscal plans.
So it's like having some breathing room, right?
Yeah.
Financially, for those unexpected things. But, like, how's India going to actually do this, achieve this debt reduction, I mean?
So they're looking at three strategies. We can call them mild, moderate, and high. They're all based on different projections for India's GDP growth rate in the coming years, of course. And they all lead to different outcomes for the debt to GDP ratio.
Projections, right?
Okay, so different scenarios. For those who like to dive deep into, the numbers, the nitty-gritty, we've included a table in our show notes that outlines these three scenarios and, their potential outcomes. So check it out. But okay, I'm curious, how does this affect the fiscal deficit? That's been a key indicator for so long. Right, the fiscal deficit. So right now it's projected at about 4.8% of GDP in FY 2024 to 25, actually lower than the initial 4.9% target. And looking ahead, the government wants to get it down to 4.4% in FY 2025 to 26.
So it's trending down
Yeah.
gradually.
Yes. And if they go with that, that moderate strategy we talked about, could go even lower, like around 3.5% of GDP by 2031.
Sounds pretty good. But are there any, downsides, challenges to this whole new approach?
Well, yeah. Trade-offs, right? Some experts, they've raised some concerns. One big one is that FRBM Act target, the 40% debt to GDP. They're saying reaching it could take a lot longer, much longer than initially projected. We could be talking decades.
So a long road ahead, possibly. What other roadblocks are experts, worried about?
Another one is crowding out, private sector investment. If the government needs to borrow a lot to finance its spending, interest rates could go up. Makes it harder for businesses to borrow and invest.
So it's like a competition for funds, almost. And the government's borrowing could, like, squeeze out the private sector, which, could hurt innovation and economic growth.
Right. And it's more concerning when you think about India's current account deficit. If they borrow a lot from abroad, that deficit could get even bigger. And that puts downward pressure on the Indian rupee.
This raises a lot of questions, especially for our UPSC listeners. So, is this new focus a risky gamble for India, or is it a smart move for a stronger economic future? What do you think? Let us know in the comments.
It's a complex issue. Definitely not any easy answers, but that's what makes it so, so interesting. Important to discuss. It's interesting, this shift. It's not JST about, reducing numbers on a balance sheet. It could actually change how India spends and invests its money, and that directly impacts economic growth.
Right. That's a great point, especially for, our UPSC listeners. It's not about memorizing stuff. It's about understanding the big picture, the implications of all this. So how could this affect India's growth, like its trajectory?
Well, think about it. This new strategy, this debt-centric approach, it could free up resources for critical investments, right? Infrastructure, social welfare programs, even fostering innovation, those are the things that drive long-term growth.
So more money for, roads, schools, hospitals, helping those in need. That's pretty positive social impact, right? But I'm guessing there's another side to this.
Of course. Trade-offs, always. Debt reduction is important, but if the government gets too focused on just trimming that ratio, the debt-to-GDP ratio, well, they might underinvest in those important areas we talked about. And that could actually slow down growth in the long run, I mean.
Right, it's that balance. Too much debt, bad. But not enough investment, also bad. Finding the right balance is key.
Exactly. And that's where those concerns come in, the ones we discussed earlier. If it takes decades to reach that 40% target, well, that means a long time of limited spending by the government. And for India, a developing economy, that might not be the best thing.
It makes you think, right? Is that target, it's ambitious, but is it too rigid? Maybe a more flexible approach would be better. One that balances debt reduction with the need to invest to keep the growth going.
That's the debate right now. Economists are talking about it. It's about finding that perfect point, a pace for debt reduction, one that's sustainable but doesn't kill investment and innovation.
And this brings up another point for our UPSC folks. India's economy, it doesn't exist in a bubble, right? It's connected to the whole global economic scene, which makes things even more complex.
Oh, absolutely. Global conditions can have a huge G-sheet impact on India managing its debt, reaching those growth goals, things like global interest rates, currency stuff, how the world economy is doing overall. All that influences India's performance.
So, if interest rates globally rise, which they have been, borrowing gets more expensive. For everyone, governments too. And that could make India's debt bigger, that 40% target, even harder to reach.
Exactly. Or imagine the world economy takes a downturn, a recession, demand for what India exports down. That hurts businesses, hurts government revenue, makes it way harder to shrink that debt-to-GDP ratio.
It's a good reminder, isn't it? Economics isn't just like numbers on a page. It's real events, global stuff, interconnectedness, and sometimes, a little bit of luck.
That's a great way to put it. So UPSC aspirants, pay attention to the global trends. It's all connected. It's all part of understanding India's economic journey and, how well it can handle this fiscal shift.
Now let's go back to those three strategies, the mild, moderate, and high ones. Just a reminder, they all depend on different GDP growth projections, which of course is affected by those global conditions we talked about. So first, the mild approach. It assumes a lower GDP growth rate. Conservative, right? So debt reduction would be slower, but it could give the government more flexibility, at least in the short term.
Right. Then there's the moderate one, assumes a slightly higher GDP growth. So debt reduction would be a bit faster, but still some room for those important investments. It's more balanced, you could say, trying to find that middle ground between being careful with money and supporting growth.
And then there's the high consolidation strategy.
Yeah.
That one is based on, a more optimistic view. High GDP growth, so the debt reduction.
Yeah.
The most aggressive. But it might mean, spending would have to be controlled more tightly, which could impact some programs, some investments.
Each one has its pluses and minuses. What the government chooses, it'll depend on a lot of things. How they see the economy growing, both in India and globally, and what their priorities are for spending and investment.
It's a tough decision, no doubt. But for our UPSC listeners, understanding these different approaches, what they assume, what could happen, that's crucial for analyzing this whole policy shift.
Absolutely. That's exactly the kind of analysis, the critical thinking that UPSC examiners want to see. They want to know you can go beyond the basics, the facts and figures. They want to see you get into the details. Way different viewpoints. Consider all the factors.
Speaking of different viewpoints, let's talk about what the experts are saying about this fiscal shift. Those concerns we mentioned, they're not just like theoretical. Real economists, analysts, people who are watching this closely, they share those concerns.
Yeah, some are saying that timeline for reaching that 40% target, it's too optimistic. They point to all the uncertainty in the global economy, the risk of crowding out, private investment, and they say India might need to spend more on things like social welfare, infrastructure, especially as the country
Now,
develops.
it's a reminder that policies, economic policies, they don't exist in a vacuum.
Huh.
There are pressures, internal and external. And you have to think about all that when you're evaluating how effective something might be.
Exactly. And that brings us back to that key question. Is this shift, is it risky, or is it the right move for India's economic future?
A question that needs, well, deep understanding of all the factors, the risks, the potential benefits, and the ability to look at all that data, all those trends, and analyze it all. And that, everyone, is why we do these deep dives. To give you, our fellow UPSC aspirants, the knowledge and the skills you need to not just pass those exams, but to be informed, engaged citizens, people who understand the world and can help shape it.
Very well said. Before we finish up this part, let's talk about the FRBM Act. We've mentioned it a few times. It's important for understanding this whole shift, the context.
Okay, let's break it down for our listeners. What is the FRBM Act, and why does it matter today?
So, FRBM Act stands for the Fiscal Responsibility and Budget Management Act. It came about in 2003. Basically, it's a law, a legislation that's all about financial discipline, reducing India's fiscal deficit,
Yeah.
and improving how the macroeconomy is managed. Think of it as like rules, guidelines to make sure the government is managing its finances responsibly.
So it's like a framework for fiscal responsibility. Sets targets, lays out how to manage the budget, the borrowing. But how does it connect to this whole debt-to-GDP focus?
Well, originally the FRBM Act, it focused on reducing the fiscal deficit. The goal was to get rid of the revenue deficit and keep the fiscal deficit at a manageable level. But now, like we've been saying, the focus is shifting to that debt to GDP ratio as the main target.
So it's a big change, how India manages its finances, moving away from just looking at the yearly deficits to a more complete assessment of how sustainable the debt is overall. And this means, the FRBM Act needs to be adjusted to fit this new target.
Exactly. They're working on it right now, amending the FRBM Act to include this new focus. On debt to GDP, the amendments will probably change the targets, how they monitor debt levels, maybe even new measures to make sure things are fiscally prudent.
Here's a question then. What will global institutions, investors, what will they think about all this? Will they see it as, a good sign that India is being responsible, or will they be worried about the risks, the challenges?
That's a great point. Those credit rating agencies, global investors, the IMF, the World Bank, they're all watching India's fiscal policies. What they think can really affect things like capital flows, investment decisions, even India's overall standing in the world economy.
So our UPSC aspirants, they need to understand this, how this shift is going to be seen by the rest of the world. It adds another layer, another level of analysis. They can't just think about what happens in India. They have to think about the international impact too.
For sure. It's all connected, right? A decision in Delhi can have a ripple effect. Global markets, investor sentiment, even India's position on the world stage economically.
That's what makes studying economics, especially for the UPSC, so fascinating. It's not just numbers and theories. It's about real-world stuff, how everything is interconnected. Okay, before we move on, let's talk about a term we've used, crowding out. We mentioned it, but it needs more explanation. Some listeners might not be familiar with it.
Good point. Crowding out. It's an important concept, especially when we're talking about debt and how much the government borrows. Basically, it's when the government borrows a lot, and that leads to less private investment. It's like the government needs so much money, it's crowding out the businesses. They can't get the funds they need.
Imagine the government wants to build a big highway, right, or a new welfare program. They need money. So they might issue bonds, borrow from banks, but that increases demand for funds, right? And that can make interest rates go up, which means it's more expensive for businesses to borrow, to invest in their own projects.
Exactly. Higher interest rates, they're like a red light for businesses. Makes it less attractive to invest, to expand. So private investment goes down, and that could hurt economic growth, the growth that comes from the private sector, I mean.
So with this fiscal shift, the worry is, if the government borrows too much to manage its debt, That crowding out could happen.
Mm,
And that could, well, it could counteract the good things from those government investments.
that's right. It's a balancing act, remember. Managing debt is important, but so is making sure the private sector can thrive. Too much focus on one, it could hurt the other.
Definitely a tightrope walk. And that's why understanding this crowding out, it's important for our UPSC folks. Helps them see the full picture. How this fiscal shift could play out. Not just the government finances, but the impact on businesses, on the whole economy.
It's about developing that broad understanding of how the economy works, how things connect, which is, of course, what the UPSC is all about.
Okay, let's shift gears a little. From India to the world, we've talked about how connected things are, but let's dig a little deeper. The global economy isn't exactly stable right now. Lots of uncertainty, lots of potential problems.
For sure. And global conditions, they're a big factor in how India's economy does. Think about it. Global trade, money moving around, commodity prices, exchange rates up and down, all that has a big impact on India managing its debt, reaching its goals, keeping things stable economically.
Like, imagine oil prices suddenly jump way up. Inflation in India, up too. People can't buy as much, economic growth slows down.
Yeah.
It's a lot harder to get that debt-to-GDP ratio down then.
Or what if there's a global recession? Suddenly other countries aren't buying as much from India. Businesses suffer, government revenue goes down.
And don't forget those financial markets, global ones. India needs foreign investment to, well, to develop. But if those markets get shaky, geopolitics, maybe some big country changes its monetary policy, that can make investors nervous. And that affects how much money flows into India.
It's like sailing a ship in rough seas, right? The global economy, those currents can push India forward, or they can really hold it back. Understanding those currents, how they could impact things, it's important for policymakers, for anyone trying to figure out what's going to happen with India's economy.
Absolutely. So UPSC aspirants, pay attention to what's happening globally. It's not just about India. It's about understanding how the world affects what happens at home.
Exactly. So as we move to our last section, keep that global context in mind. We'll talk about specific global trends, potential problems, and how they might affect India, as it tries to handle this fiscal shift, reach its economic goals.
Sounds good. Let's dive into that global landscape, see what we can learn. All right, so as we wrap up this deep dive, let's think big picture here. We've covered the what, the why, the how of this big policy change. But the question is, what could mess things up for India?
Yeah, that's the really interesting part, right? Especially for those UPSC exams. India is starting down this road, but the world economy, it's a bit, it's a bit shaky right now.
It's like sailing into a storm that's brewing, Inflation's up globally. People are talking about recessions and the geopolitical stuff. Well, that's not them.
Exactly. All those things, they could make it much harder for India to lower its debt A&D, invest in growth. It's a tough balance, even without those external pressures.
Think about it. A global recession hits. Demand for India's exports drops. Businesses struggle. Growth slows. And that debt-to-GDP ratio, way harder to shrink.
Right. Or those global interest rates. What if they keep going up? India has to pay more to borrow money, adds to their debt burden. Just a couple of examples, but it shows you the global economy, it's all connected.
It's a big lesson for our UPSC folks. Economics, it's not just theory. It's real events, stuff you can't always predict, and it affects everyone, across borders, across economies.
Right. So staying up to date on those global trends, it's not just like extra knowledge, it's essential. If you want to understand what's happening in India, how its economy is going to do, think about it. What the U.S. Federal Reserve does, it can affect how much India pays to borrow money.
Okay, let's recap quickly. We started by talking about that debt-to-GDP ratio. It's a better way to see how healthy a country's finances are, more than just looking at the yearly deficit.
We talked about why India's making this change. More transparency, more flexibility, more focus on the long term. It's a more holistic way to manage things.
And we talked about the downsides too, right? What the experts are worried about. It's not easy balancing debt reduction with those investments that are needed for growth.
And importantly, we brought in the global picture. What happens in the world can really affect whether India succeeds with this shift. Global trends, they matter a lot.
All right, UPSC aspirants, here's the challenge. Don't just memorize stuff. Think about it, analyze it, ask questions. What could happen if India makes this change? In India, in the world, it's all connected.
The UPSC examiners, they don't want just textbook answers. They want to see you think for yourself, connect the dots, understand how things work nationally, A&D, globally.
Yep.
especially in economics.
That's what separates, those who just take the UPSC exams from those who really excel. It's about seeing how the world works, how everything fits together. And economics, well, that's a big piece of the puzzle.
So stay curious, stay informed, keep your eyes on the global economy. For the UPSC, knowledge is power, right?
And that brings us to the end of our deep dive. Hope you found it interesting, something to think about. The UPSC journey, it's a marathon, not a sprint. So stay curious, stay informed, and keep learning.
What do you think about India's fiscal future? Let us know in the comments. Share this episode with your friends who are studying for the UPSC. And don't forget to subscribe for more deep dives. Until next time, happy studying.